What is happening, guys and gals? Joe Badger here, your money mentor, where we have deep pockets and short arms. Do you have the right mindset when it comes to investing in the stock market to succeed? Whether you have a little money to work with or a lot of money to work with, you want to preserve your capital. And you want to go in with the right mindset, especially if you're in it for the long term. Well, I want to take my experience, my nearly 40 years of experience investing in the stock market, and help you. So I put together 5 main tips, 5 kind of mindsets that you have to have in order to continue to succeed as you're investing along your journey. So make sure you subscribe. There's a lot more coming and you do not want to miss out. So let's get started with those 5 tips. Okay, number 1, you're going to have to build a tolerance for risk. This is very important, because we all know that the stock market goes up and down, and we're going to have to be able to ride the market. Now, in the long term, basically, all you're really doing is managing risk, because we're going to have bad markets, we're going to have good markets, and if you're going to be in it, if you're going to be investing, whether you have a lot of money or very little to work with, you want to make sure you manage it properly, and you're going to have to build some sort of tolerance for risk. Now, I personally have always had a high tolerance for risk, and that is why I went into my own business and I became an entrepreneur, and I also manage my own money in my own stock portfolio. I happen to naturally have a high tolerance for risk. If you don't naturally have a high tolerance for risk, maybe what you can do is just keep this in mind, keep this frame of mind that if you're going to be investing in the stock market, you're going to have to expect that there are ups and downs, and some days will not be good, some days will be awesome. So just keep that in mind, that if you are aware that you're going to need a high tolerance for risk, then I think in the long term, you're going to make it no problem. Number 2. Your investing money is your wealth building money. It is not all of your money. This is very important to keep in mind. It is not your emergency fund. It is not your daily money that you need to pay the mortgage, to pay your bills, to pay your utilities, to put food on the table and a roof over your head, because it's not going to be quick money. Investing money is money that you have, and this is a state of mind, keep in mind, that if something terribly goes wrong and you lose it all, that you're still going to be okay. Now, that's only theoretically. You're probably not going to lose it all, but we've all seen things over time and we can't predict the future. So keep in mind, let's just say theoretically you had a chunk of money that was, let's say, $10,000, and you put it into the stock market, and you knew you put it in great stocks or great funds or great ETFs, and then suddenly something went wrong globally, locally, whatever, and you lost all that $10,000. Now, where are you? Are you dead broke now? Can you still pay your bills? Can you still put food on the table? Are you still good for the next year or two, even though you just lost a chunk of change? This is a really important mindset to have, that the money that you use for wealth building, it's not your emergency fund. It's not the savings that get you by every day. It is money that you can do without if all else went terrible. So keep that in mind, that this money is set aside to grow over time, and most likely that's what's going to happen. If I was a betting man, and I am a betting man, and that's why I invest in the stock market, I would bet that that money is going to last you a long time. But we've all seen things happen, and if something goes wrong, especially over my long term of investing, I've seen a lot. And when something goes wrong, you want to be prepared so that you're not stuck without any money after you sunk every penny that you had into the market, and now it's gone. So, number 2, make sure that the money you are investing with is, if something goes wrong, it's expendable. Numero tres. Did I say that right? Number 3. Be prepared to lose, but expect to win. The stock market can be a tricky thing, and you have to have the right frame of mind. Over all my years, I've heard a lot of different people tell me a lot of different numbers about the long-term gain that you can expect to earn by investing in the stock market. It seemed to range anywhere from 5 to 6% over a lifetime to 7 or 8% or 9%, all the way up to maybe 10 to 12% over a lifetime in the stock market, which isn't really that bad. And that's taking in consideration inflation and things like that. Now, keep in mind, you're going to have some good years and you're going to have some bad years. One year, you might make 10%, 50%, 100%, and those are great. But keep in mind also, you're going to have some bad years. Imagine you have a down 25% year, and that has happened. There was a period after the year 2000 all the way to 2009 where we just really didn't have much growth at all, and most portfolios were down. Can you imagine having that over a long period of time? And that's terrible. And that's why you have to have the expectation that you might lose, you will lose, but the truth is you probably will win, because over a lifetime, the stock market is a winning proposition. And a lifetime seems like a long time, especially if you're trying to make a quick buck or your time frame is less than a year. And that's fine. You can make money, you can be successful, but you have to keep in the back of your mind that you may not win as soon as you put that money in there. Remember, there's Murphy's Law out there, and he's always trying to trip you up. So if you think, oh yeah, no problem, I'll put all my money in stock market and I can bank on it, and then I'll retire next year, it ain't going to happen. So make sure that, number 3, that you will expect to lose, but you hope to gain. Number 4, always educate yourself. You have to have the mindset of continuous education constantly and doing your own research. And congratulations, if you're watching this video right now, that means you're doing your research, and that's good. You're on the right path. And there are a lot of ways to do it. Since the beginning of my investing career, many years ago, I have read articles, I have read books, I have made watch lists, I have talked to professionals, whether they be accountants or financial advisors. I've talked to stockbrokers, I've talked to friends and family who do their own investing, or even if they're having somebody else do their investing. You are always constantly doing your own research, and you are always constantly educating yourself. And if it's about an individual stock or a mutual fund or an ETF or an annuity, you want to know what you're getting into. That doesn't guarantee anything, but it certainly puts you on the right path. And you don't want to just go into stock investing blindly. So make sure that you always educate yourself about the process, about the overall economy, the global economy, where things are headed, where we've been. Look up YouTube videos, read books, read articles, go on your brokerage account site, the site where your brokerage account is signed up to, and I bet you they have a lot of research tools there too, whether it's news of the day, whether it's information on an individual stock. Do your research, always educate yourself from beginning to end, and always keep up on things. This will really keep you ahead, and definitely you won't be caught off guard when something goes wrong and you're like, what just happened? Because you don't want to be the person who says, what just happened? You want to be that person that makes things happen. Okay, number 5, and this is very important and probably the most important tip when it comes to having the right mindset when you are investing your money. Investing can be very emotional. After all, we are only human, and our emotions can get in the way, whether we get too excited or too fearful, and they can really hinder our performance. Now, to say don't get emotional, don't be emotional, that would be like saying don't be human. But remember, when you start getting emotional, try to take yourself away from the equation as far as emotions go, and know that you did your research and your due diligence, and if things are working out, you're managing your risk properly. So number 5 actually is this: make sure you take profits. When you take a profit, that means you sell a stock, you sell an investment, you see it going up, you see yourself making money, and that's when greed comes into play. And this is a very real emotion, and as we all know. And what happens is you see your stock growing, maybe you're making 5% on something, maybe you're making 50%, 100%, and you're like, this thing's going to the moon. And that's an old expression in the investment industry. And no stock goes to the moon, even the best ones, even the best investors. Nothing always goes up, so you have to take a profit. Taking a profit is an industry term. That means selling. That means when you sell the stock, you made a profit, you made money. And that way, you can just sit back and relax. You can reassess your portfolio because you won. You took a gain. You took a profit. And you can even go out and celebrate. If you're one of those individuals who think you need to, or believe you need to, celebrate a win, that's a good thing. You go out and you buy yourself something. You go out and you have a good dinner. You actually spend a small portion of that winning to celebrate. And that sets a positive attitude in the back of your mind so that it's a little bit of reinforcement. And you've won this time, and then this stock, it was a good pick, because you're going to have bad picks. You're going to have losing stocks, and sometimes you're going to have to sell a loser, and it'll be for a loss of money, and nobody likes to do that. But remember to take a profit when something is going very well, and you have to determine what is good for you. Oh, I made $100 on a stock. You might be elated. Or I made $5,000, man, time to cash in. Whatever that is for you, keep in mind that at some point in time, it is very healthy to take profits. In fact, I was watching Mr. Wonderful on Shark Tank, Kevin O'Leary, and he's all about investing. And he was talking about this 3-month rule, 90-day rule, where you sell off the stocks that are doing very well, and then you reevaluate. And that's one way to go about doing it. It's a very good way to reevaluate where you are financially and where your money is. Now, that is a short period of time, 3 months. You have to decide, is that long enough? Is that too short? But either way, make sure that you celebrate the wins and enjoy the profits. Okay, let's sum up. In conclusion, I think that the overall mindset is a very positive but guarded one. In other words, you are always managing risk. You're going to have to be patient. And remember, number 1 is developing a tolerance for risk. Number 2 is allocating that investment money for investments only. Number 3 is be prepared to lose, but expect to win. Number 4, always educate yourself. And number 5 is to take a profit and celebrate and have a little fun with your winnings. Overall, I would say just be patient and remember this one last tip. Now is the best time to invest.